Welcome everyone to Value Investing Live. I'm pleased to welcome our guest today, Jim Roumell, founder and president of Roumell Asset Management, which he founded in 1998. As always, for those of you out in the audience, please feel free to post your questions and comments in the chat section throughout the presentation, but do keep in mind we are going to hold those until the Q&A section at the end. Without any further ado, I'm going to hand things over to Jim. Thanks for joining us today, Jim.
Thank you, Sydney, and thank you to Guru Focus for inviting me. I'm going to break down the talk today a little bit on my background. We'll spend some time talking about our philosophy and process at Roumell Asset Management. We will, I'll highlight a couple ideas to kind of illustrate that process and give a couple general comments on kind of overall market opportunity, although it's not something that we focus on. We're not macro investors. We're very company specific fundamental investors, but we'll touch upon it and then open it up for Q&A. I guess just a little bit on my background. I actually think it's important because I think people gravitate toward investment strategies that ultimately lie in their character ultimately being really a big function of kind of where they came from, kind of childhood experiences. I grew up in Detroit in a working class block. Most of my friends' parents, fathers worked in the plants. And I was kind of that kid that was, up and down the block with the shovel or a lawnmower, just like probably many of the people on this call today. And so I was always a hustler. I was kind of that kid, paper routes and all that stuff. And 60 years later, this year, I kind of still feel like I'm still hustling and love it. My parents divorced when I was young, and I think that was very informative for me. It was a loss at an early age, and I think it contributed greatly to the deep value investment style that I have practiced for my entire career. I think value investors, deep value investors in particular, are risk averse. I think we're looking for downside protection. I think we are focused on not how far something can go up, but really how far something can go down. And when I think of a lot of the great value investors that inform me, I see this pattern, beginning with Ben Graham, who lost his father at an early age, had to go to work to help support his family. Marty Whitman, my immediate mentor, came from a family in which his mother was one of a survivor of the Holocaust, came here before the war and lost siblings. So Marty knew loss. Could be same of Walter Schloss and Irving Kahn, really intellectual kind of mentors of mine. So I do think there is this relationship between value and deep value investors and a sense of understanding something about loss. I think we're risk averse as a group. I started writing. I entered the business as a traditional stockbroker in 1988. 1988. 1988. I opened up Roumell Asset Management in 1998. In the 90s, I spent time managing money under Raymond James's umbrella, wrote research, and was fortunate enough to having written some research that ended up on my mentor's desk, Marty Whitman. And Marty bought a few securities that I suggested and gave me a great amount of confidence that the way in which I approach securities analysis and trying to find kind of undiscovered gems worked, and we could do it. And to have his seal of approval was a great gift to me. Marty, in fact, when I formed Roumell Asset Management in 1998, agreed to be an advisor to Roumell Asset Management and was instrumental in helping get my firm off the ground. Shortly thereafter, 2000, 2001, I got invited in the Wall Street Journal stock picking contest. This is now 20 years ago. Won it 2 years in a row. And that's when things kind of changed for me, and we were able to raise capital. And here we are 20 years later. So process. We look for securities that we like to say are out of favor, overlooked, and misunderstood. We think it's very hard to add value investing in securities that are widely followed, in which the metrics that you're analyzing are pretty straightforward, which the business is fairly easy to understand, and the operating metrics are fairly easy to understand. Basically, accounting is a commodity and can be easily duplicated. And so adding investment edge through accounting, we think is hard. Now, to be clear, we actually have a first-rate accountant on our staff, Tom Gandolfo. Is a public company CFO, was a public company CFO. And it's absolutely critical to have that talent inside the shop, and Tom provides that. But at the end of the day, the investment edge for us comes from an information edge that is most often found in smaller microcap securities that are not widely followed, often with very little or no sell-side research, that we can really add value by really shaking the trees in the industry of suppliers, competitors, customers. That's what we really like to do. We are not interested in finding great businesses. We are not interested in looking for compounders. There are many people who do that. It seems to me that that is a type of investing that lends itself to indexing. There are obviously a number of people who do it and do it well and have for a long time. It's not what we do. The network we use, I think, is very important. I rarely invest in something that we do not have what I call an information edge in terms of really understanding what's happening dynamically in that industry, what's happening competitively, how cohesive is the management team, how aligned is the board. And then ultimately, we ask ourselves, would we take this company private? And that is ultimately our North Star. Would we take this private? So with that, I'm going to show a couple slides to kind of walk through this, and hopefully some of this will make more sense with what I've just said. So I'm going to okay. Sydney, can you see that? Okay, nope, no problem. So this is just a brief executive summary, and I'll just go through these bullets, quickly. We're opportunistic. So right now we hold about 40% of our portfolio in cash, not because we're trying to time the market, but because we are looking at a lot of things and haven't found sufficient number of investments that we would take private in a heartbeat. In other words, take private, meaning we would buy the entire company, where the return would be completely a function of the cash flows coming out of that company and or the opportunity to monetize assets inside the company. We have just recently, we look at this business as one of planting and harvesting. We have done a lot of harvesting recently, given the number of things that have worked out, so cash levels are high. So we do not feel compelled to stay invested. We will invest to the extent we have a great idea. As I mentioned earlier, micro small cap focus. We think those are mispricing is absolutely essential to add value. Mispricing happens in environments where there are fewer players, Information is not widely available as it is on larger situations. That's where we swim. We, as a result of the amount of work we do on companies, our focus is on really high conviction ideas. We typically look to invest, 5 to 8% positions. So we'll take a 7 or 8% position. We are looking to maybe own 15 investments, not 50. As I mentioned, we're always looking to be where the herd is not. Now that doesn't mean there's value there. It just means, in our belief, that the odds of finding value are much greater than being in heavy trafficked areas. Primary consideration for each holding always, would we take it private in a heartbeat? We're comfortable owning sizable positions in companies. We currently have a number of positions where we are, one of the top 3 or 4 largest shareholders. Again, touched upon this a moment ago. I think it's really important, particularly for younger investors who might be on this call, really build up a network. Building relationships and sustaining them over time to our business has been key. Every business that you're showing up to analyze, we are generalists, and we need to really kind of have people willing to that are kind of helping understand a particular industry. So we have built and maintained what I think is a very sizable, deep, wide network of industry contacts. A lot is not talked about behavioral edge, temperamental, emotional sturdiness, I would say. There are many, many people I've met in this industry over the years who have far more IQ points than I do. I think one of the things that I've been able to do is to manage risk, manage my own emotions, be able to basically always kind of stay in the game and not kind of get knocked off. One of the ways in which we do that and manage particularly the volatility that comes with microcap investing is we overwhelmingly stick to companies with very strong balance sheets. And the reason is pretty simple. With a strong balance sheet, we've got time. And one of the real challenges for an investor is being under the gun of having a leveraged balance sheet, leveraged capital structure in which something has to happen within a particular time period. A well-capitalized business, a cash-rich business, has time. And so we have basically very long-dated options. Secondly, with a well-capitalized company, we can average down aggressively and confidently because of the math. If you have a $200 million cap company with, say, $100 million in cash and no debt, and that stock drops 25%, you're effectively buying the business for a 50% discount, a 50% discount to the 25% stock price, because of course the 100 million in cash is standing still, and the 25% drop is you've cut off 50 million from the market cap, or 50 million, or 50% of the enterprise value. So we're able to average down aggressively, typically, and confidently, because of the types of capital structures we gravitate toward. Couple of the highlights of things we're looking for: assets. So we look for interesting assets, unique assets, assets that often are not yet really generating certainly GAAP earnings. We want companies typically that own interesting assets that are at least breaking even cash-wise, or at least we see an end in sight to cash burn. We don't want to be holding ice cubes, even if they are cash rich. A bad business will rip through a strong balance sheet. It just takes certainly a matter of time. So very unique, interesting assets. We'll talk about one in particular in a moment when I highlight our largest holding right now, GSI Technologies. Balance sheet strength I mentioned. We look for very disciplined capital allocators. We spend time trying to get to know management, the board composition, the relationship between the board and management. We really like investment redundancy, and investment redundancy simply is having multiple shots on goal. So we like to have situations where there are multiple ways to win. One of our biggest holdings over the past several years was Rosetta Stone, which got bought out last year. When we showed up, they had a consumer language business, an enterprise language business, and they had a growing, nascent, although completely unrecognized, language learning software business called Lexia, and a net cash balance sheet. And so our opportunities to win was the rationalization of the consumer business, the further penetration of the enterprise business, but at all times it was actually anchored in something that really wasn't appreciated, Lexia Learning, which was growing at over 20% a year, over 95% retention rates. But again, multiple ways to win. And then no matter how much we like a situation, we do a conservative evaluation of its assets, of its overall business, and we want a discount. And our discount has to be, minimum 35%, typically 50%. And those are the situations we wait for. And again, going back to kind of market cap orientation, you just really don't find, 50% discounts in widely trafficked ideas where there are, lots of analysts, lots of investors circling that security. And so the return in those situations, in our view, is really most dependent upon an overall rise in the market, not specific company events. I think that's really not too important. I just want to highlight one last page. Yeah. Key influencers. I think this is really important. I think it's important for investors to have sources of inspiration. We all stand on the shoulders of our heroes, so to speak. Investment-wise, these are mine. Marty Whitman, light bulb went off for me when I read Marty. You value a company independent of the market. You give up ROE for safety. Goes back to the deep value investing mantra that safety is more important than ROE for those of us who maybe have been touched by loss in a way. Walter Schloss, buy assets at a discount instead of buying earnings. Earnings can change quickly. Also, I think Schloss makes a very good point. You got to be comfortable with who you are. Your investment strategy is really an expression of your own character, your own temperament, and there needs to be alignment. Irving Kahn, favor companies that have near-term weak or no earnings. As we all know, people react typically in herds. Disappointments, particularly in earnings of growth companies, can be great, terrific places to look for value as a lot of growth investors suddenly exit. And then Seth Klarman, I'm sure you all know, a fabulous margin of safety investor. The other thing, and particularly in light of the current market, that I would note with Seth Klarman is his idea that your opportunity set is not just what's in front of you today. The opportunity set today isn't stocks, bonds, real estate, international stocks. Your opportunity set should also include what may and is likely to become available tomorrow. So as our fund sits on 40% cash right now, we're not looking at what is the best relative place to put that money. Our opportunity set includes thinking about what might be available tomorrow. So I'm going to move to two ideas. I'll make some market comments, and then we can take some Q&A. So our top holding is a company called GSI Technologies. You can see this, Sydney? Yes, okay.
Yes,
So very quickly, and this you can find on our website, roumellasset.com, under year-end 2020 letter. Without going into it, it's a chip company. It has a legacy, so very common for our investing strategy is on, we'll get into the numbers very briefly here at a high level, but GSI has a debt-free balance sheet. It's got over 60 million in cash, market cap of about 180 million or so dollars. So it's cash rich. Has a legacy chip business, a legacy SRAM chip business that we value modestly. And we take that value plus the cash in the balance sheet, they own their headquarters. We subtract that out of the market cap, and we get a residual value, which is what we're paying for what we think is the most exciting asset inside the company. And that's its new Gemini platform of chips. And Gemini is a AI chip focused on inference, not training. And the only thing I'll say, which is again in this presentation, the link to it is in the presentation, which again can be found on our website, or the year-end 2020 letter, is the Israelis' version of our DARPA is called Moffett, the basically private equity arm of their defense department that looks to curate emerging technologies through crowdsourcing technology, through putting out contests. In January, GSI won a Moffett challenge that was a software challenge to accurately determine and distinguish between humans and animals from radar signals. And so you see an object in the distance, 100 yards away. Is it a human? Is it an animal? Is it a bear? Is it a cat? GSI won that contest. There were over 1,000 entries. Our understanding is that Microsoft, Amazon, and NVIDIA all made submissions to that contest, albeit under different names that not recognizable. So we think this Gemini chip, which has just come out onto the market, is very powerful. They've got an emerging relationship with the Weizmann Institute in Israel. The purposes for their inference chip, it really applies to drug development, to facial recognition, and to search. And in the past 3 years, non-revenue producing chips that are in this ecosystem, Intel bought Nirvana for $400 million, again, pre-revenue. Intel bought Habana Systems last year for $2 billion, again, basically pre-revenue. Going to Khan's approach to look at assets, not just earnings. We think there's a great asset in here that is not yet really producing earnings, but here's what we're paying for it. If you look in this analysis, the market cap on this company is $190 million right now at basically $7 a share. Actually, the cash is closer to 60 million. And let me see here. And so the implied Gemini value is probably effectively about 50 million. It's because the cash here is this 50 million cash does not include about 12, 13 million that are in securities held past a year. So that's what we're paying for this Gemini option. That is a software and hardware chip that just recently won a Israeli challenge of AI ability to distinguish between humans and animals. So it's a free option, basically a free option in our view. This is the source of this chip is well described in this write-up that you can again find on our website. I'm going to screen share just one other quick idea that's a bit different. This is Dundee Precious Metals. Again, you'll see a common theme here, a cash-rich company that is debt-free. I'm not going to, Dundee Precious Metals is a Canadian miner. They have two very large mines in Bulgaria. The second one, Chelopech, has been producing for several years. The second one just came online about a year ago called Tepe, and they produce about 300,000 ounces of gold a year. So here's the bottom math on it. At the current price, market cap, a little over $1 billion, cash of 150 million, no debt. So you see an enterprise value there of about 932 million. However, they have a portfolio of publicly traded miners. We value that at 50 cents in the dollar. Takes the adjusted enterprise value down to less than $900 million. They also own a smelter that they have put over $300 million into in the past several years, which is not reflected on here, and we just kind of put aside because we think it's instrumental to the business, and the chance of it being sold separately is probably unlikely. So last year, Dundee Precious Metals generated over $200 million in free cash flow. Okay, so this year they will generate about 240 based on same kind of 1,700. I mean, assuming same $1,700 per ounce gold price. That free cash flow goes up because they paid off last year a forward contract. So some of their gold went to settle a liability for a forward sale on gold. So you're talking about a basically a 25% plus free cash flow yield. Now, obvious question is, well, how long is the cash flow for? According to the company, again, assuming $1,700 gold price, given about a $650 all-in cash cost, this cash flow profile is good for 5 years. So Chelopech, if you look at the company's presentation, average mine life is 8 years. Chelopech is certainly more likely 13. Tepe is probably shorter, but longer than 8. So basically, you get your money back. Again, I'm assuming $1,700 here. In 4 years, you have 150 million in cash. You've got the smelter. You've got $100 million in public securities. And you have the value that's created from the growth capex, which is pretty modest, $10 million a year. And at the end of those 4 years, you still have the optionality on expanding both Tepe and Chelopech, but both of which have many opportunities for reinvestment. So, but the bottom line is here is you have your money back in a few years. Very conservative company, instituted a dividend a year ago, now 3 cents a quarter, paying 2%. I think they can go to probably 30% of free cash flow in terms of a dividend. So I think the dividend will be going up. But at a 10% free cash flow yield off of 21 cash, you look at the bottom there, that's a $14 stock price. So again, We are not predicting gold prices here at all. But if you think about our mantra of downside protection and being most concerned about downside protection versus upside, we're just basically arbitraging a super unlevered, super high cash flow generating asset with the optionality of that production in 5-6 years. Additional production will come online, and we're basically taking very little risk for that given the cash flow profile. Okay. Just a couple little bit general kind of market comments and our opportunity set today. We don't do macro. We think that basically it ends up being the average opinion of the average opinion. I'm not a trained economist, and so it's always baffled me that people who perhaps have an edge in identifying value as it pertains to individual securities can believe themselves to be smarter than the many economists out there who have trained in macroeconomics. I will say, I know a lot of economists, none of them are really wealthy. I know a number of investors who really don't know much about economics who are wealthy, which is a real signal, clearly, that bottom-up deep value investing, or bottom-up investing really for that matter, growth or deep value, is different than economic prognosticating. And if it were otherwise, then you'd have a lot of wealthy economists. You don't. So the macroeconomic forecasting really, from what I observe, doesn't really lend itself to making money in the market. Having said that, to the extent we have a view, it goes something like this. Market cap to GDP right now, something Guru focuses on, is right now approaching 2 times, much higher than it was during the internet bubble, which I think peaked at maybe 160 or 170. So maybe it's 180, 190 right now. It's extraordinarily high. And there are reasons put forth for that. The most often told is super low interest rates, lower discounting of future cash flows results in a higher stock market. Perhaps. I would say, though, that the two things that general market investors are standing in front of are super low interest rates and high multiples. And, those are, in our view, more likely than not to go the other way. So I just kind of keep it that simple. More likely than not, rates are in some type of trough. We have no idea when and if, and perhaps they do stay down. Japan's rates have been down for a long time, so I don't get too mesmerized by it one way or the other. But I do think on a number of overall metrics, whether it's CAPE ratio, market cap to GDP, we're really kind of in uncharted territory. And so that uncharted valuation territory, in order to be sustained, requires uncharted territory in terms of these metrics, i.e. principally interest rates. What I like about our strategy and is how we really don't have to think too much about it, because we're looking for very specific situations that are trading at a discount for very specific reasons. Either A, they're really undiscovered and own things that people are unaware of. They are misunderstood because they are a little bit too hairy and a little too complex to kind of pull apart. And we have the ecosystem and the network to kind of really add an edge in terms of gaining an expertise in the underlying business. So it's so company specific, so event driven, really, that we don't really kind of worry about overall market levels on a day-to-day basis. Anything that is a going concern thesis, though, has to be heavily discounted for us right now. And we will, although we have 40% cash right now, it can get pretty quickly invested. In fact, in the past month, we have found 5% positions. So that gives a flavor of what can happen quickly if we do find things that we really like. The last thing I'll kind of say before we throw it over to Q&A is talking about incentives. And we always look at the incentives of the management and teams and the boards of the companies we invest in. But we had a reassessment of our own incentives last year, which I think we've been greatly benefited by. I had historically kept well over 50% of my own financial net worth in our fund. And I determined that while our advisors are often putting maybe 5-7% of their clients' capital in our fund, we were actually not aligned. And I was not aligned. And I was not aligned because we were being too conservative, because I had such a disproportionate amount of my net worth in the fund that I think it was causing me to hedge maybe too much, not take as big of positions, and not candidly investing the fund as aggressively as it should be based upon having 5 to 7% pieces of people's capital. And so I made a commitment last year to actually reduce it, disclosed it to clients, and really understood to our advisors. And I committed to keeping a third, which is 5-6 times our average allocation from a client. And that has really made a big difference. Going back to the concept of loss I talked about early on, you have to invest this capital, in our case, this particular fund, in a way that is actually aligned with our clients. And for me to do that, I actually had to reduce my exposure to the fund, and it has been wonderful. Our fund, in its Lipper categories, in the 1 percentile now for the 1, 3, and 5 year periods. It's just under 50% for the 10-year period, because we had a hiccup in 13 and 14 and 15. So interestingly, alignment from a manager's perspective, in my experience, isn't necessarily having the most amount of capital in the fund. It's the right amount of capital in the fund, given who the investors in that fund are. So with that, Sydney, I think we're ready to take some questions.
Okay, yes, thank you so much for all that great information. All right, the first question that we have today is, how do you reduce your average cost, as you referenced during your discussion on your strategy? Do you have any tips?
Yeah, good question. So we typically don't leg back in, average down, if you will, until there's at least a 15% drop. However, let's say we have targeted a position to be 5%. And we like the position. Nothing has really changed except the price. What we're really aiming toward is within maybe a 20% drop. Let's say you buy something at 10 and it's now 8. We're still aiming for that kind of 5%. However, if the discount drops materially, let's say 25%, then the position size will actually maybe go from 5% to 7%. So again, if our analysis hasn't changed and the stock has dropped 25%, well, you're basically, your position size is a reflection of the level of discount you have, right? And so I would say, a 25% discount would probably take a 5% position to 7%. So that's how we kind of think about it. Short of that, we just keep trying to basically add and to basically kind of bring it back to 5%.
All right, perfect. The second question that we have are, what are the catalysts and risks for the two stocks you presented? So GSI Technologies and Dundee Precious Metals.
Sure. So again, in both cases, we think it's much easier to, so to speak, see the floor than to kind of see the ceiling. We first and foremost don't see a lot of downside because of the capital structures. Having said that, the question, so the risk with GSIT would be that they've got this great chip, this Gemini class of chips, this AI associated processing chip, which, as you'll read about if you go to our website and read the write-up, is where the processing is occurring in the memory. And so it's this great chip. But GSI is a small company, $200 million market cap. And it's going to take some time to get that story out and to sell that chip. Now, the Israeli win will really help bring attention to it. But, it's like the analogy I use, it's like a drug company, a little biotech that develops a great drug, but really doesn't have the sales force to go out and get it into hospital formularies or to get it into the community. That job is done by, big pharma, Pfizer and Merck and whatnot. So I think ultimately GSI will be purchased because I think it's, a heavy lift to create the sales momentum. So I would say that the risk is that, revenue, and we, by the way, we don't expect any big revenue ramp from Gemini this year. It's an SRAM business with the Gemini option. We expect announcements about engagements. We'll expect some wins, but we're not expecting any real revenue ramp this year. That will be, I think, in 22. But I think there will be material announcements showing partnerships and design wins and so forth. But the risk there would be that it takes longer than expected. I think the SRAM business there, that's their legacy business, is pretty sturdy. In other words, they have indicated while consumer SRAM has been a business in decline, they have developed new end markets for their legacy SRAM business, which are enterprise, which are really government, defense, and satellite. And they've been pretty clear that business is kind of stable to slightly growing, but at higher gross margins. So I think the SRAM business plus the cash provides a pretty sturdy foundation there. With Dundee Precious Metals, I mean, of course, the biggest risk is a dramatic drop in gold prices. But again, all in, I mean, you can do the math. All in cash cost is $650. Gold right now at $1,700 an ounce. Roughly 300,000 ounces. If gold drops $200, multiplied by 300,000 ounces, that's your kind of segue, your beta in terms of cash flow. So, again, at a 25% starting off free cash flow yield, you got a lot of room. The other thing, in addition to gold prices with a miner, is, look, these are big mines and stuff goes wrong. Dundee Precious Metals, sadly, in the fourth quarter last year, had an accidental death at one of its mines. Really, really sad event, and really unusual too, because they have a fabulous track record in terms of safety track record. You go to their website. They've always spent a tremendous amount of time focusing on safety. But you can have minor events that can be material. So I would say operational blow-ups, if you will, and the price of gold on DPM.
All right, thanks so much for answering. Yes, that is very sad that they had that terrible accident. Let's see. Another audience member is asking, how are you able to forecast the net present value of loss-making microcaps? Might be a complicated question.
Yeah. How are we able to? Can you repeat that, Sydney?
Oh yeah, sure. How are you able to forecast the net present value of loss-making microcaps?
Well, we can't really, but here's how we try to mitigate. And I think I understand the question. How do we try to mitigate the erosion of value that might come from perennial losses before a company's ready for prime time? And so if you take a look at GSIT, it's really a perfect example. We got introduced to GSIT in 2015 or 16. We started buying shares less than $4 a share. They have generated, albeit a small amount, of cash every year for the past several years while developing the Gemini chip. So they have taken basically cash flow from their legacy SRAM business, kept costs down, reinvested in Gemini, and so you don't have a perennial loser. So if you recall, one of my earlier comments was we like to identify companies that have multiple options but are not burning cash. So at least the balance sheet is staying still while these investment activities are hopefully creating wealth. So similarly, when I mentioned that Rosetta Stone was our largest position over the past probably 10 years, during the time we owned it, Rosetta's, we started buying it at $7 or $8 a share. They developed Lexia Learning. They repurposed their enterprise language learning software. This is being sold to K through 12 and to corporations. They did all that while basically maintaining roughly $30 million in cash in their balance sheet, kind of cash neutral. But after 4 years, the company was sold for $30. So basically 4x the stock price. But during that time, make no mistake, they had no GAAP earnings. But what they did was they grew their subscriber base on Lexia. They rationalized the consumer business. So they built wealth. They built a wealth, a greater wealth generating machine with basically not generating any GAAP earnings during that time, but by doing it by growing subscribers, in which those subscribers by that buyer last year could be discounted to a present value that for that buyer approached $30. So if we do get involved with the company, a micro, which is overwhelmingly our cocktail of choice, sometimes they are burning cash, but we see a recap. We see we just get involved in a situation now where we see a recap that is going to really dramatically reduce their cost of capital. Perfect example, one of our top holdings in the past 2 years has been ComScore. They've had this $200 million 12% piece of debt held by Starboard. Stock 3 months ago was at $2. It's close to $4 now, simply because they did a recap. They found basically a preferred investor, cleaned up the balance sheet, and the stock was a double. So I hope that answers the question.
Okay, the next question I have is, how do you decide if an investment, or determine, I guess, how do you determine if an investment is not working in your portfolio?
So we recently had a situation where we basically sold the security for basically the same price we bought it for, because we spoke to someone who had actually toured the company's operations, and there was a division of this company that we thought was really kind of beginning to really kind of was poised to grow. And the feedback we got was there were only a handful of employees in this one division. There was some talking with them, and the project was much more delayed than thought. There was an overall sense of kind of malaise, and it was a very different representation from what I felt we got from the company's top management. And so obviously during COVID, we've been unable to go visit and kick tires as we're accustomed to doing. So this is a situation where, we got a piece of feedback back, and we could be wrong, by the way. We could be over valuing this piece of information, but it didn't add up to me. And so we just decided to exit. If I don't feel good at every moment, I've got a discounted security, I've got something worth substantially more than what I'm owning it, I don't want to own it. That's just a lesson learned after having done this for over 30 years. Let's see. We don't see ourselves as activists. We don't go into situations to be active. But last year we did run a full proxy campaign against Enzo Biochem, ENZ, because we really determined the board management were not aligned with shareholders. We're doing perennial things to undermine value creation, and so sometimes we will get involved. And in Enzo's situation, earlier this week, it was announced that the chairman is stepping down as CEO. He's staying on the board. So we will get involved sometimes. The other thing that we will exit a security based on, if we really determine and we got something wrong up front about the kind of people we're involved with, and we kind of come to the conclusion they're not really ethical, honest actors, we will typically exit, because in my experience, there's just there's more cockroaches there, and they'll eventually come out.
All right. Okay, so let's see. My next question is, what advice do you have for people who are just getting into their investment journey?
Wonderful question. I would, going back to a couple of things I touched upon, I would focus on self-reflection. I would focus on understanding who you are, where your talents are most likely to be realized. So for instance, I'm a fairly extroverted person. I've always been fairly comfortable walking up to people and introducing myself. So I've always found it easy to go to trade shows and to introduce myself to industry participants, and that's something I kind of really enjoy. I think if that's something you don't like, which is fine, you have to find a way up the hill, so to speak, that is really in line with your own temperament, character, and skills. I really don't think anyone should really try to do something that doesn't come relatively natural. Not to say that there's not, clearly room for improvement and room for growth, but I don't think you should be running against your grain. So the first thing I would say is to basically find your grain, whatever that might be. For me, when I read Marty Whitman, a light bulb went off and it just kind of became my North Star. And I think you have to just, I would start there and then be patient.
Okay, thanks so much. That is great advice, Jim. Our final question is pretty easy. This listener wants to know what your typical time frame. Do you have a preference for a typical time frame that you want to hold an investment?
Sure. So we do not want to hold an investment forever. We are typically identifying a trigger, a value trigger that, if we're roughly right, should be occurring within 2 years. And so, again, going back to an earlier comment, we're not identifying great companies that are compounders that can reinvest capital at great rates, and so why ever sell? No, we're looking at really mispriced securities that are standing in front of some type of catalyst, be it GSI getting bought because of its Gemini portfolio, be it DPM's cash flow getting more recognized in the market given how much it's generating, and I think maybe one person follows DPM. Whether it's ComScore getting recapitalized, whether it's Rosetta Stone getting bought out, which took a little bit longer than we thought. And to be clear, we weren't there at the final purchase. We did very well, but we weren't there for the final couple innings. So I would say if we're roughly right, our investment thesis should be playing out within 12 to 24 months.
All right. Well, Jim, I think that rounds things out for the majority of our questions today. Thank you so much from everyone here at Guru Focus and for joining us, and thank you for the audience out there for taking the time out of your day to join our Value Investing Live. It's been a pleasure to have you.
Thank you, Sydney. I've enjoyed it.
Yes. And then for those of you who joined us today, if you want to watch again, there will be a full video recap available. There will be a full video recap available on YouTube as well as on Guru Focus. We can make some contact information available down in the description as well. Thank you all for joining us today. We hope you have a good rest of your week.